Good morning to everyone. I hope everyone's ready for an exciting quarterly review. This is probably one of the greatest changes we've seen in landscape in Australian property markets and taxation for a long time. So I think the information is pretty interesting, and all the people that have been asking us questions since budget on the 12th of May sort of focusing on similar themes. But without carrying on too much, let's get on with it and go through this. First of all, it's a disclaimer, all of this is general information only, so if anyone needs or wants personal financial advice, then by all means please reach out and we can assist you, and I hope you find this of interest. Navigating the strategic pivot, well, this time it's not just interest rates, which really was the key issue in the last quarterly review. Now we've got the added, complications that the government has thrown at everybody in the in the federal budget, and that relates around taxation treatment of investments, the ability to use negative gearing, and the impact of the proposed capital gains tax changes. And I just want to, I suppose, also stress that these changes are proposed changes, so there's likely to be quite a lot of bargaining between various political parties and between the government and the business councils, etc. So it's not set in stone, but given the fact that Labor has the Greens in their corner, I think most people should probably work on the fact that most of these changes are going to get passed. So just a bit of background for people that don't know us. Our various businesses consist of Wise Guru, which is the international consulting business that helps mainly Australian expats all around the globe with their specific needs in terms of finance, property acquisition, taxation, coordination, all of the things associated with those sort of transactions, which are clearly even more difficult to execute when you're living overseas. Unicorp Partners is the financial advisory business that was founded some 38 years ago. Aussie Loan Guru is our lending business, which again focuses on mainly the professions and Australian expats and entrepreneurs to assist them with some niche financing solutions that aren't available in the wider marketplace. And Aussie Property Guru, as the name suggests, is the licensed real estate business. So just a bit of background, but most of our clients really, doesn't matter if they're a surgeon or a banker or an entrepreneur, they're high income earners, they're usually very time poor, they do want to make better informed research choices, and most of them obviously want to buy some property in Australia because that still forms a very large plank in most people's personal asset base. So they want to build wealth in an affordable and especially in a tax efficient manner. That's pretty important for most of our clients, and I think it's going to get even more important now with these proposed budget changes. So we charge a concierge service if people want to avail themselves of this. It enables us to, make life a little easier in terms of assisting the whole process and recommending other professionals that can help people acquire a property and make sure they do so in the right manner. Okay, well look, the most common questions we've been getting lately have changed a bit now, because now people are saying, well, how much will the RBA continue to increase interest rates by? Some people are still saying, look, will they remain on hold this year? But that's really diminished greatly since the last quarterly review. And I'll go through and give you my opinion on this. Another question that's clearly popped its head up now is, how will the proposed government changes to negative gearing and capital gains tax discounts impact me? Because everyone's obviously really concerned about their own situation. Will property prices go up over the next year or two, or will they crash? A lot of people are asking that because headlines are coming out with contradictory information almost on a daily basis. And the other thing is also very important coming up. Will rents start increasing even further now that these proposed tax changes are likely to get passed? And most importantly, which areas still provide upside prospects due to population growth? Now, whether that's from interstate migration or overseas migration is relevant, but it's important that you have population growth. So let's look at this, because now, research across our vast country is more important than ever, and I'll run through why, as I think these tax changes will impact different markets around the country in different ways. We use, the national data houses, Cotality, the Australian Bureau of Statistics, Urbis, Oxford, etc., and put all of those statistics, I suppose, together, and then use nearly 4 decades of practical experience to try and sort through that and come up with some meaningful trends that really we expect to see over not just the next year, but over the medium to longer term. So here we are, the biggest tax reforms in a generation. Capital gains tax discount of 50% is proposed to be abolished, replaced by an indexation mechanism, which really was sort of pre-1999, and a minimum tax of 30%. Negative gearing. Losses are quarantined for people that own properties prior to budget night. And going forward, those deductions will be limited to the same asset class. So people will no longer be able to offset any holding cost losses, i.e. expenses greater than income from these properties, and they will be able to utilise those, but only against the same asset class. So this is going to impact a lot of people, and I think this is a big one. But there is a carve out, and because the government has said that they're trying to make things more equitable for the younger generations, I'm still trying to figure out quite how they work that one out with this budget. But forgetting that, the carve out is that new builds, so people constructing new homes will still get to enjoy the benefits of negative gearing as we see it up to budget night, and that is really important, especially for people who are on higher incomes and looking to buy quality new real estate assets. So that will protect them in a pretty significant manner. It's one of the good things that happens. The taxation of trusts, again, the government here probably has created a bit of a mess, and I can see that there's going to be quite a lot of toing and froing going on in relation to these proposed changes. We can already see that coming out in the media since budget night. They're proposing that trust distributions are going to be taxed at a minimum of 30%. Now that's a non-refundable tax credit, so if it goes to an individual, they'll be able to utilise it. But if it goes to a corporate beneficiary, they won't. So you'll end up with double taxation, where if you have a bucket company now, it'd be taxed up to or in excess of 60%. So that will really get rid of that altogether. And I think, again, we'll just have to wait and see what happens here. But there's also the situation where there may be an unintended consequence on testamentary trusts, which brings forth the spectre of inheritance tax, perhaps. So I think the government has a lot of work to do to get some of these changes across. But then, as I said earlier, we've got to bear in mind that the Greens are actually wanting to have even more draconian changes to the tax system. So it really is something to watch. And certainly at our next quarterly review, we should be able to have a lot more clarity on the situation. The permanent instant asset write-offs have been continued, and loss carrybacks for the last couple of years of profits for corporate entities is a positive thing. But overall, I think most people recognise that the changes from this budget are probably more negative than positive. So for most of our clients who are property investors or looking to become property investors, here's the new system. post-capital gains tax assets, which are most of them, was 50% protected from capital gains tax up until budget night. Now the 50% discount will only be on growth up to next June, so 30th of June 2027, and indexation applies after that under the new system. New assets, well, there's no change, so it's going to be same as it is now, and as I said, that's really important because the government does recognise that Australia needs housing, more housing, desperately. Pre-CGT assets, and I think for most of our clients, that's not really going to be a major issue. So pre-1985 are going to lose their status from 1 July next year also. So quite a lot of things happening here. The upshot of it is that the main residence exemption has remained. So people, I guess, will potentially look to, if they can afford to, go into higher quality, higher value assets to live in because they're going to be shielded from capital gains tax going forward. And obviously the eligible new build, so where a new dwelling's constructed and more than the original number of dwellings is built on it, can choose between the 50% discount which currently applies or the new indexed arrangements. Very important. Okay, well, interest rates, as I said earlier, that's a question we're getting all the time. Will they go up again? The consensus in financial markets is that they will, and you know, you've got different pricing for 1, 2, or sometimes even 3 increases. I think that's probably going to be a bridge too far, but pardon me, now that the RBA is back at the level they were at when they started reducing rates, so they've gone up and raised rates 3 times, we're at 4.35 for the official cash rate. I think it is restrictive, and I think some of the data coming through is showing that up. If we look at the unemployment number, the most recent one just out, you know, back at 4.5%, I think the RBA will start looking at that because it is one of its mandates as well, not just to maintain inflation within their target 2 to 3% band, but to maintain employment. Interest rates edging up, well, we're seeing that, and we've been seeing that continually through the last few months of this year. In fact, now, you know, after the latest rate increase in May, most owner-occupied rates are over 6%, and most investor rates are probably around, you know, 6.3 to 6.6% depending on the lender that you're looking at. So I think there'll be a move higher. As you can see there, I expect the RBA to increase again by 25 points either in August or September, and at this point in time I think that's probably going to be the size of it, but markets are betting that obviously there's going to be more than that, so there'll be 2 rate increases. I think we need to have a look at the data as it comes through between now and then to make a call on that, because I think the situation in the economy is on a bit of a knife's edge. So I don't think we can just say, well, you know, markets are betting we're going to get 2 to 3 increases. I think we can be a little bit more measured than that. Now, again, this is something that we've seen coming through over the last 12 months. I mean, the value of investor lending was up nearly 18% up till the end of last quarter, but it's up just under 8% over the year now. And what I think will happen post-budget, post these changes kicking in, is that we're going to see the value of investor lending really decline for a period of time. And we can see that already in terms of what's happening in various markets. Now, I'll go through that in a bit more detail as we go through because it particularly impacts Sydney and Melbourne. But I think, you know, interest rates will continue to edge up. So there's no denying that, and people need to be aware of it. However, I think at some point in time, you know, the impact of those interest rates, the proposed government changes, and the, you know, consumer sentiment in the economy is going to come to a bit of a head, and then the RBA will have to look at what to do after that, and that's to protect employment. So one of the really important things is obviously Australia's future and population. And again, if we look at what's happening on a political front now, the rise of popularity of One Nation is probably quite alarming for both the Labor government and for the coalition, because on the latest poll, and I think it was conducted on the weekend, One Nation has surged ahead in terms of what would occur if they were to hold an election now. And whilst One Nation hasn't come out with a raft of policy agenda, one of them is to limit overseas migration. So worth bearing in mind, but again, I'll come through it in a bit more detail later, because the current numbers, if we look at it here, I mean, Australia's still growing very strongly. Over 27.7 million people as of September, which are the latest ABS data, and growth continues at a very strong pace for a developed nation, 1.6% per annum. And obviously that's peaked post-COVID, but it's still, one of the largest increases of record, as we continue to see in most quarters going forward. This is from the last Centre of Population Growth projections, and we can see that the projections going out to 2034 see a decline in some of these rates of growth. In fact, what we've seen over the last over the last several quarters is that these weren't quite correct, and WA and Queensland are leading the way in terms of population growth, and that's continuing. The other one was people saying, well, what's going to happen to the banks, especially if new lending declines, and new lending will decline when these changes hit properly. But what's happening in housing credit is not alarming in any way. Australia's still in a very robust situation. APRA announced a new round of credit tightening with macroprudential policy, which went into effect in February, imposing a 20% limit on high debt-to-income lending, as they call it. And if we look at, which is over 6 times debt to income, but if we look at that in the graphs, we can see there isn't really a meaningful increase in any of that. There's no meaningful increase, in fact, in any of the lending that people call riskier. So whether it be interest only, and I can't see why that is actually risky. I know what it refers to, but in reality, if you have strong borrowers, they can clearly pay interest only for a long period of time. Higher LVRs, we're seeing that really come through from the government's 5% deposit scheme for first homeowners. So, nothing really there that I can see that would concern me in any way. But let's look at property as an asset class, because it's a really important one. As we can see there, residential property is now valued at $12.6 trillion Australia-wide, and it's the major asset that most Australians own. And if you look at the amount of outstanding mortgage debt, it's 2.6 trillion. So not only do most Australians own this asset, but most of them are not really leveraged, and the numbers are still consistent. It's only about a third of Australians have a mortgage. So it's worth bearing in mind, because most clients that we speak to actually do have a mortgage, the ones certainly that are not in the baby boomer demographic, and so they think everyone has a mortgage, but that's not the case. And again, we look at what is happening to values. Well, over the last 12 months, values increased nationally by 9.8%. So that's it's a generic number. The last quarter was 1.6%. But if we have a look at the variation, Perth was up 26%, Melbourne was up 2%. So I think that's where the importance really lies, that we've got, and that's why I say research is so important. We've got to look at things in a lot more granularity than sort of headline numbers would suggest is what happens on a uniform basis, because Australia is not like Singapore or Switzerland where it's a small country and everything's pretty much the same over the whole nation, as it were. Our nation's way too large for that. It's a continent. So what's the potential impact going to be now with these transitional rules and changes the government's bringing in? And they're going to be many and varied. As I said, I think the most important thing that we'll see is a massive decline in transactions. So you think about it, if people are grandfathered and they currently have negative gearing and protection, people are going to keep those properties and not be as ready to sell them or be loath to sell them. So what happens, then? I mean, it's a situation where I can't see the benefit for younger Australians, to be honest. Everyone's going to face these new headwinds in terms of making gains. A lot of people that rely on capital gains are going to be very badly impacted by these changes, because a lot of our clients may be invested in high growth equities, or be founders of businesses where they've worked really hard for a long time to try and make a business grow, and then all of a sudden, when they succeed and potentially make a lot of profit out of that, they're going to lose, under the current situation, potentially up to 47% of that in tax. So there are a lot of things that really need to be borne in mind, but I think there's still a bit of water to pass under the bridge here, and we'll have a lot more clarity, as I said, by the next quarterly review. But it's really important to recognise that removal of the 50% capital gains tax discount means higher tax bills for most investors, and the minimum 30% tax rate on capital gains is going to be another headwind. So let's see what happens. But coming back to the variation in property markets, as we can see here, over the last 3 months, dwelling values, as I said, went up 1.6% over the quarter. But have a look here, Melbourne was down 1.5%, Sydney was down 0.9%, Perth was up over 6%. So really large differences, and that's what we're seeing. If you look at in even more granularity, if you look at it by market segment, you can see that the upper quartile segments in both Melbourne and Sydney suffered the greatest declines. The medium or the mid quartile also declined in Melbourne. So Melbourne's the weakest market, as we can see there. Perth and Brisbane and then Adelaide are the strongest markets. And that's been really flowing through for a long time in terms of the strength of markets, but this weakness has only just really occurred now. So I think that's what people need to recognise. And I think, as I said, these proposed tax changes will exacerbate that, because what will happen is, people will stand back. So sellers won't sell, buyers will not know whether they need to buy or want to buy or not, and there'll be a bit of a stalemate and a slowdown. But I think there's another add-on problem here, and that is that it may actually force rentals to increase further. I'll come back to that, because the supply and demand situation is critical, and it's been very poor for a long time, as we can see by those graphs. It's been below the long-term averages, and my concern is that if these changes are enacted in legislation, then, and the slowdown occurs in the marketplace, then potentially you're going to get even less new dwellings being constructed, because projects may not stack up. So, if the general public's borrowing capacities are impacted, and they will be substantially with the removal of negative gearing, it's going to cause a bit of a flow-on effect. and it may crimp new housing stock coming to market. So again, we'll have to wait and see on that, because it takes some time for these things to actually flow through, but something to bear in mind. Now, this situation we've looked at over several quarters, because people keep asking us, what's a better asset to have? And the reality is they're both good growth assets. They just have different attributes and they perform differently. One's mark to market and one isn't. So, if you're borrowing against that particular asset, then you're going to suffer or be faced with different challenges if you have severe market movements, especially if those movements are down. And again, these proposed tax changes now need to be borne in mind in both asset classes. So whether you're in equities or real estate, there are going to be different impacts, and that's sort of a subject for a whole other discussion. But please, if you need any further information on that, or how you think it will impact you, please reach out. One of the, beneficial outcomes of the budget was that the government has decided to leave the taxation of superannuation alone, and I think certainly a lot of our clients hold their equity exposure within the superannuation umbrella, so they're going to continue to have that preferred tax treatment, which now is especially useful. So coming back to what I was saying before about rents, and we've seen an acceleration since mid-25, and that's strengthened in the last quarter. So one of the reasons, supply and demand. The vacancy rates are so low in most markets around the country that there's a lot of competition for any dwelling that comes to market. And currently annual rental growth has averaged again in aggregate 5.7%. That's national. It's a national figure, but in many markets it's been far higher than that. And that's a significant impost to people renting. Yields have increased, especially in regional areas, as you'd expect. But I think one of the other things that's happening, and may happen even further now, is that lack of new dwelling supply coming to areas where people actually already want to live. So they want to live in areas that are more central, perhaps in capital city locations, closer to amenities, closer to where they're working, and all of those new builds there, I think, will struggle even further in the coming quarters. So you've got two different and distinct demographics asking the same question regarding the market's direction. The people that own properties and are renting them out at the moment, what's going to happen to the rental market, and the people who are renting currently and looking to buy something are asking the same questions. But the problem now is that you have a lot of younger Australians, so let's say people aged between their late 20s and their mid 40s, who are currently renting and can't afford to buy something in an area that they want to live in. So they've been investing in property and renting it out, so that rent vesting term. Now that's really going to change, because if that cohort cannot get the benefits of negative gearing, A, they probably won't be able to afford to buy those properties, and B, if they can afford to buy one, it may not be the quality of asset that you'd actually want to buy to make sure that you do have a high likelihood of achieving that good capital gain over the longer term. So pretty relevant. As you can see there, that annual rate of rental growth, 5.7%, it's really kicked up pretty sharply. I think that'll continue. So if we look at what's going to happen in the next quarter, I think you'll see that even higher, which is not good news. Not good news for anyone that's renting, but unfortunately I think that's probably going to be what transpires. So we'll wait and see. As we can see, the rates of increase again vary wildly. So important to look at that data depending on which area you're looking to invest in, or if you're renting, where you're living. Gross rental yields have really been fairly stable. They've ticked up again in the last quarter, and it's an inverse relationship to the value of the properties. So nationally the gross rental yield's 3.59%. It's up from that cyclical low of 3.55%. So it's not really a massive change in terms of that, but a lot of people who are renting in more desirable areas are facing rent increases which are far higher than that. And that's what these numbers mask and people don't recognise. So what does all that data tell us? And how do we use this research? Because as I said before, Australia is a continent. It's not a country. If you have a look at the size of that, that's just, putting in Europe, the UK, into overlaying that onto the Australian continent, and you can see it's massive. So, for people overseas, this is really important because they don't actually generally recognise how big this country is. So, it's important obviously for all of us, Australians also, but it's something that needs to be borne in mind so that we can get a bit of context around how much work goes into putting that research together. If you have a look at this, over the last 40 years, Australia's housing market has navigated downturns where values fell by at least a 3 month period 40 times. Over the last years, over the last 40 years, and the biggest decline was during that period prior to COVID, 2017, 2019, when you had the massive increase in interest rates and credit tightening overall, and that was, as we can see there, by far and away the worst. But values still only fell by 8.2%. So I think, and again, that's a national number, so it varied in different areas, but we need to bear that in mind. So I think if we do have a downturn in the market here, again, that may be different if you're living in Sydney or Melbourne, or Perth or Brisbane or Adelaide, and it will be different. But it's easy to look at that and then say, well, how long does that usually last? And if you look back at the data, it's most of the time that the period of downturn is not very long. So what else do we look at? Listing activity, and this is what I'm saying. I think currently, with what's happening now, listing activity is going to tank. If we look at what's happened to new listings, they're up over the last 12 months. If you look at that number nationally, 22.5%, higher for the combined capitals, but total listings are down. And I think this is a number you need to focus on. I think there are going to be far fewer properties brought onto the market for sale in the short term, at least until there's some clarity in terms of these proposed tax changes going through or not, and people standing back and taking a pretty long, hard look at their current situation and saying, well, look, if I've got assets that are grandfathered now and are working well for me from a tax viewpoint and a capital growth viewpoint, and have been doing so to date, they're probably going to hang on to those if they can afford to. So, that's going to bring less listings, less transactions. There'll be flow-on impacts for that because it's going to impact other parts of the economy. Real estate businesses, real estate agencies, fewer transactions, mortgage brokers, banks, valuers, the list goes on. So, I think the government will need to look at many of those things, and then, of course, if that does soften labour conditions further, then the RBA will have to start paying more attention to what's going on. So there are a lot of moving parts in this. It's not just a simple situation of changing 3 or 4 major items. They're going to have significant impact. Home buyer preferences. This was, we've seen this over the last 5 or 6 years, ever since COVID. people wanting larger dwellings to live in, people wanting multi-purpose rooms so they can set up a home office. These are just things that are continuing to, I suppose, expand on a nuanced basis where buyer preferences are sort of focusing more on quality of life, amenities, enjoyment, characteristics of where they want to live. So people are getting more fussy as they can afford to, and really want everything. And that goes not just for people who are looking to buy something to live in, but also from a rental viewpoint. So tenants who can afford to want all those things as well. So if we look at, both short and long term value growth of property, of assets in the different markets, have a look at the variation there. Darwin over a 10-year period, 27.2%, Brisbane 119.5%. So that gives you an idea, I suppose, of the variance that occurs in this scenario. And as we can see there, the rolling 3 months to the end of April, we've seen a slight decline there in all markets. But if you have a look at the declines in Melbourne and Sydney, they've been, pretty pronounced. And look, I think realistically, that's probably what we're going to see in the short term continue. But I think certain markets, we know certain markets are going to react differently, and I think the smaller capitals are going to see a much better outcome than Sydney and Melbourne. As we always say to our clients, it's really as easy as pie, and that's where we're talking about investing in residential real estate. You need population growth, you need infrastructure growth, and you need employment growth to underpin, I think, long-term housing value gain in those regions. And that's always proven to be the case. It's really important, and you've got to be careful that you don't fall foul of the situation where certain areas at different times have spectacular rises in population, but that's not generally sustainable. So if we look at Sydney, New South Wales market, New South Wales is still, has been, I think, the most diversified economy in Australia, but now, affordability is increasally becoming the challenge. It's been the biggest challenge for a while, but now with the removal, as I said, of potential removal of negative gearing, it's going to crimp people's borrowing capacity with the banks, and that's going to become, I think, the next really big challenge in that market. Interestingly enough, even over the last, couple of weekends where we've seen auction clearance rates go down to, below 40% in Sydney, ongoing quality properties are still selling pretty well, and the demand's ongoing. But quality price growth has turned negative, as I said before, and the biggest demand still comes from net overseas migration, and overseas migrants initially generally tend to rent for some time, for a period of years, so it impacts which part of, or which segment of the property market is supported the most. So if you look at that there, over the last quarter, Sydney's down 0.9%, 0.6% of that happened in April, in the last month, and over the last year values were up 4.2%. So I think it's more this situation here that's telling for that market, and it looks like it's going to decline further. Melbourne, again, overseas migration there has boosted the population. Most of that is, short term, so a lot of overseas students, because Melbourne's always positioned its tertiary learning institutions very well and marketed those very well, especially in Asia and India. So rental affordability, interestingly enough, remains with the lowest growth in any of the capital city markets. And if you look at quarterly price growth, it is negative, but it's now negative 1.5% for the quarter, 0.6% of that coming in April. So it's been negative first, and it's continuing to lead capital city markets. Values are only up 2% over the last 12 months overall. So I think, look, from the looks of things, I think Melbourne's going to be the weakest market going forward in the next quarter, certainly. Then we look at the opposite side of the bell curve, and that's Perth. It's had the highest annual capital city price growth, ahead of Brisbane and Darwin, highest percentage population growth. Important to note that is percentage, so it's not normal numbers, and that's important. It's had high annual rental growth for all dwellings, and their affordability really is becoming the issue now, which is great to see for people that own property in Perth, in WA. But, you know, if you look at that, dwelling values, they're up 26% over the last 12 months, 6.8% for the quarter, and 2.1% in April. So, you know, if you look at that, it's a very strong market. But that's where, you know, affordability is starting to bite. If you have a look at home value, you know, this is Cotality's hedonic home value index. So it's at the end of April, and you can see the dispersion there. I mean, you know, median values of the combined capitals is a bit over $1 million. But, you know, there is a fair bit of dispersion there in terms of highest to lowest. Highest is clearly Sydney, and that's why, as I said, you know, the affordability factor there is probably going to be felt the most. And Melbourne's just been a weakening market, and I think due in part to the Victorian government introducing property taxes over the last period of time that really are trying to, you know, gain some more revenue for the state's coffers. But I think there's a lot of, you know, Victoria's challenged, as everyone knows, and the government's not really doing anything very useful to help that situation. So at present, I think there's still going to be more pressure on particularly Melbourne than other capital city markets. Now, this is a question that we've always got. It's interesting now, though, that the answer's different. So people ask, you know, should I buy a new investment property or an old one? And up until now, I've always said, well, there's no right answer to that. It just depends. And it still does depend. I mean, you know, if you're nearing retirement or have a lot of spare time on your hands, or you've been involved in the construction industry, and you've got the time and skill set to add value to an old property, it could still work very well. However, the game's changed. Now, for an investor to be able to enjoy the benefits of negative gearing on performing such a project, they would have to demolish the existing dwelling and build more than the existing dwellings on that piece of land. So if there was a house, they'd have to at least build 2 properties on there. So you get a lot of, you know, situations where perhaps planning laws intervene and other things come into the equation. So it's not like before where you can just go and knock something down and effectively rebuild it and sell it for more money and get a good gain and get a good tax outcome. So, you know, that new reality, as I said before now, it's really changed the game. And I think people need to bear that in mind, because, you know, negative gearing quarantining is it's going to be I think it's the biggest issue. So, you know, if you bought your property before 7:30 p.m. on 12th of May, which was budget night, you're quarantined. So, you know, you're grandfathered. Your losses can be offset against your other wages or personal exertion income. If you didn't, are you buying an eligible new build? Yes. Again, losses can be offset to other income to help spur housing supply. If not, so if it's an existing property, the losses are quarantined. And that's where the problem, you know, that's where the problem lies. And I think that's what's got to hit home, and people will see that. And if you look at that, that loss can only be carried forward to future positive gearing, so future excess income or capital gains on that asset class. And I think the index cost base obviously is going to be reduced on future sales, so it's not as attractive. So now I think we've always relied on the fact that new property has certain characteristics: fewer maintenance and repair issues, appeals to higher quality tenants, it's easier to rent and manage, and you get some really important tax depreciation benefits. None of that's changed. But now the incentives for more new housing supply, meaning that you can maintain negative gearing on these properties, is really a game changer, I think, for people that can utilise those benefits and are trying to grow their asset base through residential property. So the Division 40, Division 43 tax benefits remain. They haven't been touched, so that's really important. And again, if we're looking at people on the maximum tax rate, and what we've got to look at, it's not just the people that are on the maximum tax rate now, because bracket creep has been bringing more and more wage earning Australians up in terms of the amount of maximum tax that they're going to be charged. So it's really worth bearing in mind. I think you need to look at this in great detail when buying an investment property, and we can obviously assist people in getting a pretty good indication of how that would impact them from a tax viewpoint. So when we look at all the data, and this has been consistent for some time and very positive for many of our clients, Southeast Queensland, Brisbane, Gold Coast, Sunshine Coast have been standouts in terms of what we thought were regions that held the most value for sustainable longer term growth. And there's still a substantial gap in especially higher quality assets between those markets and say Sydney. There's strong rental growth and there's structural tailwinds. It's had the strongest interstate migration 15 to 20 years, quarter upon quarter. Look at the ABS statistics and it just continues to go on. The work from home lifestyle factors, I think they've actually sort of ingrained themselves in the Australian society to a large extent now. So, people, if they can utilise that, like, the lifestyle market. So they're often coastal markets. And they say, well, if we need to, we can commute to Sydney and Melbourne in relation to performing tasks within an office environment and live here where we enjoy ourselves more. It has a very diversified economy as well. And now we've got that real bonus of the 2032 Olympics, because that keeps drawing closer, and it's not just that 2-week period in time. So if we look at Brisbane, April 1.2% increase in values, 4.7% over the quarter, and 19.7% over the last 12 months. So a strong market. It will, like all other markets, still be impacted, I think, by consumer sentiment following the proposed tax changes from the budget. So I expect, like Sydney and Melbourne and every other capital city market, that there will be a decline in transactions, that people will tend to sit back and try and let the dust settle and see what happens. So I think that'll have an impact on the market, but those fundamental tailwinds mean that it's going to remain, I think, one of the strongest markets in the country. So if we look at that, if you have a look at, first of all, look at overseas migration, New South Wales and Victoria generally have always had the highest number of net overseas migration additions, and that continues. But as I said, people who are coming here from overseas, and a lot of those are students or temporary residents, are going to rent. So you've got to look at that, and I think the challenge for renters is going to be that potentially you're going to see less rental availability, and therefore an increase in price. But then if you have a look at interstate migration, and here it's really important because most of those people are moving from one state to another from within Australia. They've got new employment, they're going to put their kids into new schools, and they're going to buy something rather than rent somewhere in the main. This is a generalisation, but it holds true. So again, the biggest outflow is from New South Wales, as we can see there. There's not many people moving to Victoria from interstate, and the biggest gainer has been Queensland, as it has been for many quarters now. WA is still really strong, and you know, they're really the main markets benefiting from that. But if you look at the growth rates, I mean, you know, WA is 2.2%, 1.7% for Queensland and Victoria. So really strong. And this is the latest data again to September 25, and it shows, you know, that outflow from New South Wales. And as we can see there, you know, Queensland's the highest net beneficiary of all of that. This has been in existence since the last report that was created by the Centre for Population, and it's sort of running pretty true to form since it was created. So, you know, we can see that sort of moderate decline here where we are coming through. I think that's probably what's going to occur. A lot of that depends perhaps on political will over the time. But as you know, as all of our clients know, we keep an eye on these data sets on an ongoing basis, on a quarterly basis as they come out. So at least everyone can be well informed. So if we look at markets with a bit more granularity, as I was saying, if you look at, this is the Brisbane market, if you look at the shortfall in housing supply, and I think that's what people really need to look at. I mean, the baseline here, and this is sort of for inner Brisbane, apartment supply requires about 7,500 apartments annually to meet demand pre-COVID. As we can see here, you know, that really hasn't been met since 2018, and currently, and this is prior to these proposed changes, that new supply is dwindling and really becoming rather scarce. And I think that'll actually be exacerbated by this. I think developers will potentially hold back from launching new projects. So what will happen then, of course, is if projects are not launched, then, you know, it will put upward pressure on existing stock. So prices will rise, and we'll need to see that occur for some time. Supply will come down, I think. Prices will tend to go up, and then new supply will come to the market again, but there's going to be a time lag. And I think that's just going to create more upside, I think, for the people that own quality assets in these markets now. And if people are buying the right assets from here on going forward, they should also benefit from that. So, you know, it's not something to, I guess, treat lightly, because the Olympics only on for a 2-week period, as we saw in Sydney in 2000. But if we look at the lead up to that, the amount of increase in Sydney, you know, was massively greater than the other capital cities in Australia. But I think with Brisbane it's even different, and I think it's not just, you know, all the infrastructure that's being created for the Olympics and the employment growth and economic growth in general, but once the Olympics are over, there are going to be billions of people around the world that actually know where Brisbane is, that don't know where it is now. And believe me, if you're overseas and you say to someone, you know, Brisbane, most people don't know where Brisbane is. So I think there are going to be some longer term economic benefits that flow through to property markets in that southeast Queensland region going forward in the decade after the Olympics. Anyone that's been there now knows that there's been a lot of infrastructure already developed, currently being developed, and closer to finishing and still kicking off, not just for the Olympics, but encompassing those matters. So let's have a look at this.
It's never going to be like other games. It'll be a Queensland Games. We can't just build for a few weeks of competition. We've got to build for the decades to come. We need a plan, and it's time to deliver.
The only thing bigger than the Olympic and Paralympic Games is the opportunity to connect Queensland by building the roads and infrastructure we're going to need for decades to come, all while we drive tourism and back our grassroots clubs. And now the new Queensland government has set the plan to deliver it. To keep our growing population moving now and beyond 2032, Queensland needs a better connected and accessible transport network. For Brisbane, there'll be new rail lines and stations, with new northern and eastern bus priority corridors, and road upgrades will get people around a growing city. There'll also be an exciting new sports and entertainment precinct in the heart of Brisbane, where Victoria Park will become home to Brisbane Stadium, designed to attract world-class events. The Centenary Pool will be transformed to become our national aquatic centre, with more than 25,000 seats and multiple pools, ready to host international competitions and train the next generation of champions. New life will be breathed into the RNA Showgrounds, as well as housing the Brisbane Athlete Village. An upgraded 20,000-seat arena will host key events and give the Queensland Ekka an even brighter future. A major upgrade of the Queensland Tennis Centre will include a new 3,000-seat show court arena and 12 new match courts, which, in addition to Pat Rafter Arena, will bring even more tournaments to Brisbane. Across the city, existing venues will come alive. Plus, there'll be new and accessible indoor sports centres at Logan and Moreton Bay, and a new whitewater rafting centre in the Redlands. From Brisbane to the Gold Coast, faster rail with new stations will reduce commute times, while future upgrades to the Coomera Connector and M1 will connect growing cities. The Gold Coast will be home to an athlete village and host events at a new arena, an upgraded hockey centre and convention centre, while hosting the triathlon will showcase our golden beaches. In Toowoomba, the famous showgrounds will be transformed into an equestrian centre of excellence. To the Sunshine Coast, Queenslanders will ride the wave, a new direct rail line linking with a state-of-the-art metro hub that will connect to the Sunshine Coast Airport through Maroochydore. The CBD will be transformed with a new integrated athlete village, arena and cultural precinct. These Queensland Games will reach beyond Brisbane, delivering generational infrastructure for the whole state, including a better Bruce Highway, connecting the regions and the rest of Queensland. This plan delivers legacy beyond the Games with the largest investment in infrastructure in Queensland history. Athlete villages will become homes for thousands of Queenslanders. The private sector will be engaged to turn the Gabba into an entertainment precinct with new housing, giving Queenslanders even more ways to enjoy Brisbane and providing access to bigger and better sports and entertainment. A Games we can all be proud of, and a legacy that will live on for generations of Queenslanders for decades to come.
Sounds like a plan to me. Let the Games begin.
So, I think that video really portrayed what's going on and what will continue to go on for many years from now in a really realistic sense. And I think what people recognise, that they see that this event is not a 2-week event, and it's not the build up to that. It's a whole situation of potentially having the next couple of decades of growth in that region. So what's the value proposition, I suppose, in terms of what we're speaking about? Well, it's buying into a strong market of the future, and that's what we've been saying about that southeast Queensland region for quite a number of years now, and that's playing through, and I think that'll continue to play through. Interestingly enough, we did that in Sydney 15 to 20 years ago for probably a period of 10 years, where Sydney didn't really go anywhere, but it was a strong market of the future. The other important thing is now there's information everywhere. There's no lack of information or research statistics in the marketplace, but how do you put them together? That's really the important thing. And then I think you've also got to, recognise that experience is pretty important. So if you live through changes and recognise what impact they make, it's much more, it's far easier to make some rational choices rather than just looking at data in its own right. You can't afford to ignore your point of difference. And we often find clients that want to do that because they've been wanting to do something for a very long time, they haven't, and then when they finally decide to do something, they say, oh, we need to do more of this, and we'll just get more of the same thing. But that's really dangerous, so I'll go into that a little bit further. Waiting too long to invest is probably, the sort of analysis paralysis where people continue to research something and never do anything. And you see that not just in this asset class, we see it also with people when they're investing in businesses, in equities. They may continue to look at something and watch it increase year in, year out and not do anything. So really important, and any investment won't do. So if you're going to have something that has no unique attributes, you're really going to be at the whim of the market sentiment in general. So if you have a look at that, when I say any property won't do, quite often you get areas, Docklands in Melbourne's one of them, Surfers Paradise in Queensland, or Port Hedland in WA. WA is a strong economy. Port Hedland focused solely on iron ore. So it's a one-trick pony in some respects. So you've got to be careful there because you can get massive volatility both in rental incomes and in property values and in finding a buyer. And if you go to areas such as, say, Docklands or Surfers Paradise, where they build towers with 1,000 little units in them that generally have been produced in a suboptimal way, I suppose, where floor plates are challenged, they're too small, they've been sold mainly in offshore Asian markets, you're going to have a problem if you're wanting to sell your apartment 10 years down the track and there are 300 just like yours in that building. So, let's put it all together, and that's what we try and do. We look at strong economic activity that's sustainable. So, it's strong now, it's growing, there is infrastructure growth, so it already has good infrastructure, but it's continuing to be built out. There's continuing employment growth because that underpins that population growth. You have got many unique attributes for your property, especially now. I think that's super important post these changes, to propose changes to the taxation system, because I think, and certainly for a lot of our clients, and we help them with this, if you're a high income person, you're looking to efficiently purchase a high quality asset, then you can buy a new build where you have negative gearing, but with the end prospect in mind that if you ever want to sell that, you're going to sell that to an owner-occupier. And we find now an increasing proportion of owner-occupier purchases are being made by people in cash. So they already have the money. They're not reliant upon what interest rates are. In fact, most of them are happy when interest rates are high because they have cash on deposit. So you're looking at a specific segment, and it requires a lot of, as I said, research, practical experience, and the ability to meld that together to help people to make these well-informed and potentially far more attractive choices for their assets for the future. The future sustainability is really important. So let's look at some opportunities for now and for the future. And what I tend to do is
I'm here in Brisbane,
go and look at things before, during and after.
And behind me is a new site that's being built, made, say, this is approximately 4 kilometres from the CBD, in close proximity to Royal Brisbane Hospital, and you have a lot of amenity around this area in terms of transport, in terms of restaurants, bars, places you can go to in Fortitude Valley, which is clearly not far removed. And it's interesting to note that the skyline here reflects some of the urban development that's happening in the sort of inner middle ring of the Brisbane region. We always like to have a look at construction before and during and after when sites are getting built to give us a far better understanding of what our clients are going to see when they receive their finished product.
So that and this are examples of what has already transpired and what's being built currently in terms of some of the projects that we look at, and we look at many different projects over the period of the years. But it's really important, I stress this to our clients, is to go for something that people want. As we looked at that ANZ survey, people want larger living spaces. They want luxury, amenity, security. They want all of those things. It doesn't matter if they're buying or renting. We're all human and we want the same things. We want good things. So it's really about trying to be able to capture the ability to enter into those projects, because most things, I shouldn't say most things, but many things that get built in various markets certainly are not aimed at the owner-occupier. They're aimed at an investor market where price is the biggest concern, I suppose, both for the builders and potentially then for the purchasers. So when you're only buying something due to price, you potentially may end up with something that you didn't bargain for. You're not going to end up with the best outcome just because you're buying something for the cheapest price. In fact, generally it's the opposite. So, let's look at this, and this has been, if we're looking at this slide here, this is prior to the proposed tax changes from the federal budget. So, in this situation, if you're Australian, buying an investment property in Australia, you paid for about 5 or 6%, the ATA for about 20 odd, and the tenant for about 72, 73. Now, this is going to change dramatically, of course, because going forward, this will only apply to new builds, because if you're buying an investment property after the 1st of July 2027, you won't be able to offset any losses against your personal exertion or wages income. So it's going to look totally different. But this is what it's like, and still remains that way if you're buying a new build asset. So we provide what's known as a property investment analysis report, which gives people a pretty good indication of what the costs of acquisition should be and the ongoing costs of ownership are likely to look like. And that enables people to make an informed choice. So, this property is going to cost you whatever it is, $150 a week, or cost you $0, or produce a positive outcome. Whatever the case may be, you can look at that and say, yes, look, I think I like that. That suits what I want to do. It, of course, varies if you're a foreign tax resident. So, for our Australian expat clients, those negative gearing benefits can't be used immediately because they're not earning generally Australian taxable income. Now, quite a number of our clients obviously have a larger and more mature property portfolio, and they are then earning Australian taxable income, which are rents. So, they can utilise those negative gearing benefits running along. But regardless of that, they are quarantined for the future, and you can offset future capital gains or future income when you move back to Australia from personal exertion and utilise those losses, which become very valuable. So here it is, non-residents without sufficient Australian taxable income will get to spend the savings when they repatriate or sell. That's the bottom line. This is a slide, and I've updated this because it's been very interesting. If you look at, what people want to do with investments, and we still get the question sometimes from people, particularly from expats residing in Asian hubs. What if I sold it just after I bought it, or what if I sold it the year after I bought it, or can I sell it before I even settle on it? So that's speculation, and most people, speculate, generally speaking, in other asset classes, say, the crypto market, or perhaps in equities even, because they're far easier to, they're far more liquid, easier to sell and diversify, if you like. So if you own 1,000 BHP shares, you can afford to sell 100 and keep the other 900. It's very difficult to sell a 3-bedroom house or apartment by the bedroom. So the more interesting thing, though, of course, is most people that invest for the longer term, and as I say, spend the time and effort and get the assistance and research to help them choose high quality assets that continue to grow over time, really get the benefit over time, and they don't have to do anything. They don't have to spend hours watching Bloomberg screens or their phones or other data to see when might be a good time to buy or sell. Because a lot of those people just spin the wheels and create a lot more heat than light. So the more intelligent investor looks at this on a longer term. And as you can see here, the highest level of sales occurs between years 2 and 6. And if I look at other data, the highest loss-making sales, and it's like less than 5% in Australian residential property markets around the country, that's where they're going to occur in the very near time frame after purchasing something. So as you can see here, the median return per hold period, and this is current data going back to the beginning of this year, really grows, as you can see there, exponentially over time. So one of the reasons we find that people who are owner-occupiers looking to enter the market at the moment, currently, or have been for some time, can afford to buy luxury apartments is because they have the money. So they've bought their home maybe 40 years ago, and it's grown by $5, $10, $20 million over that period of time, depending on where it is, and that gives them the ability to then choose the style of dwelling that they'd like in retirement. So it's really, really important, I think, to keep all of these things in mind. If you want to get a good outcome that's both tax efficient and, most importantly, capital value efficient over time, then it's really, really important to look at all of these things. So, what we try and do, utilising our length of being in the market, our experience, is we also help our clients through the lending business with special nuanced lending capacities. So Aussie Loan Guru can give clients up to 85% LVR or loan to value ratio loans without them having to pay mortgage insurance, which can save them tens of thousands of dollars. We've helped many people over the years and obviously continue to do so, but now we also help Australian expats, and there are a lot of Australian expats around the world, and give them the benefit of our experience with, especially the medical industry and professionals and entrepreneurs in Australia, and try and gain access to the quality assets that we think are important for them when they're building that residential property asset portfolio for themselves. We're happy to consult with anyone that would like to obtain help from us and look at their individual situation. So, please don't hesitate to reach out, email us or call us, and we'll have somebody contact you and arrange a Zoom meeting to go through your personal situation and see how we can help you. And lastly, if if it's not too much to ask, if all the people who see this this video, either now or when it's published on our YouTube channel online, please send feedback and let us know how we can, you know, make future amendments to the content and the presentation to help people even more than we think we can now. All the very best. I wish you happy investing. And now, if anyone has any questions, please let me know.